Thank y'all for taking your time out of your day and choosing to come hear me present on our portfolio process. This time last year, I was scheduled to present on our investment management process, but I had the flu and couldn't make it. So Lan said he wanted me to give it a go again. So he asked, the marching orders were to talk about how we create, implement, and maintain our investment portfolios. And, so we're going to talk about HTP's investment process. And y'all might remember from 4, 5, 6 years ago, we talked about process. The Baton Rouge is what the Tabasco company gives their employees that pick peppers. And they take this little red stick by Baton Rouge, and if the pepper out in Avery Island is this color, they pick it. So it's my example of process. It's real simple, it's repeatable, as David said. And so that's what I've tried to create for our team, so people know what to expect, our clients know what to expect, and then when we look at returns, if it's not performing as expected, then from there, we can dig deeper to find where the problem is. So how we build and maintain our models, as we'll discuss. We're going to talk about how we document our decisions, communicate internally and externally with our clients, and then it all starts with what we believe. And so when you start at the beginning, I always use the T-chart. Cash is your mad money, bonds for fixed income, shock absorbers, and stocks for growth. This is a chart that I've been using since pre-1995. It's part of information that I had from a book. This is from 1995 when I was with Interstate Johnson Lane. So what do I believe? I still have this book 40 years later. Will and Ben and those guys love to go through it. But it's what you believe and what you know to be true is what you are going to take with you and share with your clients with enthusiasm. Going back to that, now with the push for alts and the talk of cryptocurrency, I guess from an asset class standpoint, you have to be prepared to talk about it. But from a simplicity standpoint, it's stocks, bonds, and cash. Do you need it for a rainy day? Are you looking for income? Are you looking for growth? And the other thing that I think is important that I look at, it doesn't matter whether I'm traveling in Atlanta, overseas, is there's certain factors that I'm cognizant of, whether I'm reading, whatever I'm doing. What's the economy doing? Corporate earnings, employment, interest rates, inflation. What are the global issues? Ukraine, Israel. And so our goal is to take, and identify the risk and manage those risks through the planning process. And so when I'm reading, when I'm doing anything, that's what I'm looking for, what's registered in my brain. You're in Croatia and you see 20 skyscrapers going up and cranes in the air. It's been like that for the last 11 years. So when we started to build our process for when we came to IFG, Crystal was nice enough to give us a 3 or 4 page dissertation on the advisor as a portfolio manager and what to know. You can find this on InfoNet. Most of what we do comes from around this. But I think the most important thing is we all have to remember is we're a fiduciary. You have a duty to the client, a standard of care to do the right thing and make decisions for them and in their best interest. So there's key tasks that we're going to go through, but in setting up the investment policy statement, tracking the investments, being risk aware, determining the portfolio structure. It's also important to know the internal expenses, and then Crystal's charge in here is to have daily, quarterly, and annual review process. So we'll touch on that real quick. Checking on the internal expenses. And then this is just something she wrote to write, but it's what the SEC expects us to do. And that's to document. And so we've done our best to follow this, and weekly, Ben Butler and I get together on Friday to go over, and we've got a schedule. And so this is what along the lines of what we do. But when you have a process, it needs to be something that supports your beliefs. So when I chuckled when I saw this when I was getting prepared for today, from 1995, it's like, I believe everything that's still in that book. The things that are in there still hold true today, whether you put an overlay of commodities or euros or currencies or crypto. I believe that, and it's stand the test of time. So our approach is to build portfolios that, through the financial planning process, we can match to our clients' needs. We want to know what are their priorities. We determine their income needs, determine their risk tolerance, and then we develop the financial plan to go with it. And so our portfolios are an active passive in what we build. We use the S&P 600, the S&P 400, the total S&P 500, and our growth portfolio, our dividend income portfolio, and then in our blue chip growth portfolio, we go more towards the Russell 3000. So we get a little bit different blend from the two objectives. We like the active index. We'll use a DFA, emerging markets, REITs, some of the funds like that, to be specific. And then in some of the asset classes, we want to have an active manager. Typically not in the large cap space, but in the small cap international, we find that you can add some extra return or some characteristics that we might want to have in the portfolio. So following the rules of investment sourcing, quantitative, qualitative analysis, and then we do the ongoing monitoring. So we think we satisfy, if the Department of Labor, FINRA, SEC came in and we had a complaint, we feel like we got it covered pretty good. So in our model management program, we start with on the lower end with a 20% in stocks going up to 100%. Basically have 5 core portfolios we work off of with a mix of large cap, small, mid, international, and then fixed income. On our fixed income, we separate it between core, it's going to be treasuries and corporates, and then we call it alternative income, where we're taking risk, we're stretching for yield. It's not maybe going to give you as much downside protection, but if you're buying REITs, utilities, high yield bonds, they are going to have the stock-like characteristics, and that's identifying the risk and having the sleeves in the bucket. We feel very confident that one of the main things we're trying to do is we're trying to invest money on a risk-adjusted basis, and we want to beat inflation. And this goes back this goes to 91, and it just shows the optimized returns along the efficient frontier. And so that's the basis of our portfolios, starting, if you don't have 20% in stocks, you're taking more risk than if you're 100% in bonds from an inflation and a return standpoint over a period of time. Some people want to be 100% in stocks, but the farther you get out on the efficient frontier, the more air you have and the more volatility you have. So most of our money is going to really be between the 60-40 and the 80-20, statistically. It's your most efficient portfolios. Somebody doesn't want to have anything in stocks, obviously we would do it, but they're really not a client, they're a CD buyer. Because if you put them in any kind of duration or longer bond, they're going to get stock-like volatility and they're not going to be happy. So there would really be more of an annuity type situation. We all know the markets go up and down. The good news is since 1950, it's predominantly gone up. The periods of time when it's flat and you see the kind of the plateaus, those are excellent times to have active management. We also use active management for styles standpoint, and we'll go into that in a second. But we know from asset allocation and from a risk to return basis that any one year stocks can be down 38%. But if you look over time, that drops dramatically, and you actually see more risk in being more in bonds than actually in stocks. So it's once again, we're using rear view mirror back tested, but our thesis is solid. When you look at the optimum point where you beat inflation, it starts with that at least 40% in stocks and down to the 20%. So if you're trying to preserve purchasing power, stocks play a huge part in that equation. You have to be conscious of value and growth. I mentioned we run a growth portfolio and a value portfolio with dividend income. They're going to perform differently at different times. If you own anything other than the S&P 500 and the Magnificent Seven the last 2 years, you've underperformed. There's no way to unless you had a market-weighted portfolio, you're going to have kept up unless you are heavy in tech. And that's it's a hard concept to explain when your portfolio might be up 18%, but the overall market is up 28%, or a dividend portfolio that's 60-40 is up 10%. But that same portfolio was only down half as much or a third as much as the market. So one thing that we're charged is to have benchmarks. This set of benchmarks aligns with, we also have a third portfolio of an equity income. And we run it a little differently, 70-30, 50-50, and 30-70. We picked simple benchmarks to manage against. We might not in an equity income portfolio want to necessarily be planning on outperforming the S&P on the upside, but people know what the S&P is. And rather than trying to create a custom benchmark that people stand to change, I've seen just too many firms, the sales force complains because they don't like the benchmarks and as soon as they change them to the new benchmarks, then they don't outperform those. So we just take basic custom benchmarks and apply it across, pretty much similar to that across all the portfolios. On talking about compliance, when you run, we run Wealth Vision for our accounts, they're the investment objectives. Those investment objectives are the same ones that you see on the account opening page. So when you check aggressive growth, when you open a new account, that translates into ClientWorks, and to me, that's your investment policy. If you get sued and you have a portfolio that's 100% in cash and you set aggressive growth, you're going to go to the mediation and you lose. So when our financial planner goes to work on the financial plan and do the allocation within Wealth Vision, when she sees aggressive growth, she clicks it, and then we know which portfolio that we've created that matches up to it from a risk-reward basis. That way you get fewer calls from Ron Wren saying your portfolio is out of whack. And if we have accounts that have performed better and the stock portion is 70%, it should be 60. Then when we meet with the client, we say, okay, our investment objective has been 60-40. The markets have been good to us, so we need to take profit, or I need to adjust your investment objective. It's keeping the client in the loop. It's showing that there, once again, it's a process, but it's a process that the financial planner that helps us knows, Will, Ben, Chris, everybody is on the same page. We also match these up from a standpoint of if somebody's going to do systematic distributions to asset allocation fund with MFS or JP Morgan or Franklin, and so that we can put, if somebody's going to take $2,000 a month, we put $24,000 in the MFS growth allocation fund and systematically withdraw from there. So all those things line up so you don't have to think and wonder, what am I supposed to do? What did Mark want? What did Ben want? So going back a few more back to the early 90s, when I left Merrill Lynch, I went to Barnett Bank and I ran their investment department. They were all excited to get over there, and all of a sudden I realized they didn't have research. I'm sitting on the square in Marietta, and I had to create my own research. It's one of those things that at 24 or 25, however I was, I didn't ask all the right questions. They had Argus Research, which was really bad. So a friend of mine, their family, the Crawfords, ran a dividend income producing portfolio, had $1 billion back in the day, and I was like, well, I think I'll just buy that Moody's book, and that started off being my research. And so my portfolios for the last 40 years have, a lot of them is focused around the dividend aristocrats, companies that raise their dividends regularly. That's what I believe in. It's an easy story to sell. It's consistent from a cash flow standpoint, but that's again, what do you believe? You got to believe in your heart what works. My mom hated bonds. She would buy a dividend stock any day of the week. She had, when she passed a couple years ago, I think she had 93% in stocks. And she'd say, well, what is this? It's not down, the market's down. I said, well, Mom, that's your American Fund Capital Income Builder. What does that mean? Bonds. Hang up on you. But people understand Coca-Cola, it pays me a dividend and the stock goes up. It makes a difference. So what do we know about and this is from Dearborn. Dearborn does a good job. We use their mutual funds sometimes, and we also use 2 of their SMAs. And so part of what Lan said, well, how do you communicate to people? Well, one of the problems when you rerun your own money at LPL is being able to recreate or really have a presentation that's compliance approved. So this is from Dearborn, it's compliant approved, but it talks about the dividend growth companies, and that they have averaged since 73 10%, and so a growth of $100 grew to 16,000. When you look at companies that cut their dividends, they're flat. No dividend paying stocks up 4%. S&P equal weighted up 7.8. And I think the equal weighted part I thought was appropriate to bring up. Everybody's S&P right now, because we've been in an up market, is market weighted. So in our portfolios where we run individual stocks, we run the individual stocks on an equal weighted standpoint, but we match it with the Russell 1000 or an index that's weighted. So we get the combination. Then you look at standard deviation, it's 16, the measure of volatility between 24 on non-dividend. So we got a portfolio that grows consistently, gives us some cash flow, lower volatility. They're market leaders. They can cover their cash flow, and so there's that potential that they will continue to raise it. Our portfolio in 2008 raised its dividends 12%. Now, the portfolio was down 24%, and that's no fun, but if you're solving for that cash flow need of your client from a financial planning standpoint, and if they had, call it $20,000 worth of income in '07, and they go up to $22,000, well, they didn't get a haircut. They still got to go and do what they were doing because you planned on the income side. So there are a number of different dividend strategies. You can do high yield, you can do an increasing or rising dividend. But here, going back to, I think this is 2014, 2012, you start with just under around $6,000 in income, you end up with 15. So you got that steady increase in cash flow. How many people like a pay raise? I wish we could put our advisory fees on an escalator, but that's not how it works. But that same portfolio, it generated over that time $135,000. The value, if you reinvested, grew to $944,000. That's strong. I can believe that. That's something that people can understand, is you're going to invest money, we're going to get you cash flow, and we really have very high conviction that we're going to increase your cash flow between now and the time you retire and need to turn the spigot on. We talked about the being more of a high dividend income. This portfolio would have kicked off $188,000, and it'd be worth $877,000. So you've got a 4.5%, 5% dividend. So you get half the return coming from income, the other half is coming from the growth. But if you're in a cash distribution, then it makes for a good portfolio and tax efficient at 15%. So how do you measure success with a dividend income portfolio? You outperform inflation first. You outperform from a tax standpoint because it's taxed at a maximum of 15%. So we feel like that's a pretty strong portfolio. As far as this shows the simple Excel spreadsheet we have from the different sleeves where we match the index with the active managers and then the allocations that go for each sleeve, each bucket, and for each of the portfolios. So it's you could click on that in our 365, go right to it, know what's in there, and know what to expect. On our dividend income portfolio, key attribute, we overweight the REITs by 7%, 7% versus 2% on the S&P 500. Technology, we underweight that to lower the volatility, and then we have an overweight in utilities because of the cash flow needs. So we've got strong characteristics built into it. From there, Ben, we do one sector a week. So Ben will run the technology sector. We run it through FCRFA MarketScope. It gets us their opinion. 5's good, 3 is a hold. If it's something that's a 3 or a 2, we dig in, look a little deeper, see what the other people on the street are saying. We know CFRA enjoys, valuations, and if things get overvalued, they're going to lower. So, we don't necessarily just sell because it's a 2, but we definitely use it as our barometer to dig deeper. We use FI360 to measure the mutual funds and ETFs. Green's good, top quartile, yellow's hold, a red is eliminate. There's 10 or 11 different things that go into that, from manager tenure, expenses, how they perform against their peers. Ben runs this for the dividend income portfolio. We run it weekly. So if something changes once a month, we've got a pretty good feel for if something needs to be looked at. If the fund's in the top quartile, which you would expect out of the Vanguard Russell 1000 growth. It's pretty self-explanatory, but clients understand that. Trustees of 401k plans understand green is good, go. Oh, red, we got a problem here. What should we do? We also use the Y charts. We took the 60/40 portfolio for our dividend income, the blue chip, the equity income, and we've got an index, pure index iShare ETF we run also. So from satisfying that need to know how the portfolios are doing to their benchmark. I've got that on my desktop. We review each of the strategies, regularly on a monthly basis. So that you can tell that when you talk to people or talking to a client and they want to know, well, why the benchmark for 60/40 was up 18, but you're only up 17, but we saved on the downside the year before, and instead of being down, I believe it's 24, down 15, the equity income and the decent portfolio were down 6 and 7%. So half the downside is with that. Communication internally, probably something similar to what they use with Bryce and them. Makes it easy to either send an email or set the trade ticket on Ben's desk. Everybody uses it. It's the same thing as continuity. We do, model rationales, explaining, we're selling this, depending on the trade, the detail we get, but, what different models is it going to be affected? And that's emailed out to the team when we trade. This is our quarterly schedule, and I'm not going to read it to you, but everything we went through, we have a system where everything is covered. We cover over 12 weeks, basically the 11 sectors of the S&P 500 over the quarter. So we're constantly rotating, and it's just what we do at noon on Friday. If I'm not there, Ben emails it to me. If he's out of town, he emails it to me on Thursday, and he probably spends an hour and a half, 2 hours putting our weekly information together. He sends this chart out to everybody, showing the returns for the week, for the year on our different portfolios that we have. Also at the top, you see the internal expenses and the yield. So with that, got to determine what you believe. You have to document what you're doing, but you're doing that to help to match people's objectives, help get them to define their priorities, determine their income needs, define their risk, and then developing that financial plan that supports where the client wants to go. And that's what we do to build portfolios. Probably spend a pretty good bit of time a week on it, but I like to know what I own. It's built off of what I've been doing for 40 years, and it becomes old hat. So with that, any questions?
Do you do planning? So when you come in, you do a plan first with clients?
Yes.
Right?
Yes.
And then basically this is how do you accomplish your goals, which then tells them. Now, what you use eMoney or?
We use Wealth Vision, eMoney. And so for the first part of what we do, there's 7 questions that I start with, and I'm sure my team's tired of it because y'all be tired of it. Define your priorities, determine your income needs, your risk tolerance. I mean, if I got to know that. But the other piece of the puzzle I tell people, and call it an elevator speech, whatever you want to call it, but who do you love? what do you owe, and what do you own? If you can tell me your income needs, your risk tolerance, and what your priorities are, and who you love, and what you owe or own, those 7 things I need to know from you to build a plan.
Right.
In 10 words. And from there, it's stocks, bonds, and cash. I love Bitcoin. Man, I bet you if you had it for a long time, I'm sure you made a lot. What we're going to do is we're going to inventory what you own, what you owe. We're going to look at what your income's going to be. We're going to take it and we're going to put it in our financial planning program, Wealth Vision. And we're going to address your long-term care needs, your taxes, your RMDs, and then we're going to have a recommendation of how much risk you need to take or don't need to take.
Right.
And then from there, we charge for the plan. If somebody's real, then I don't want to pay, and they're going to, you bring $1 million in, then we'll credit you the first quarter's fee to make up for the planning fee. Right. If you bring business to us. But I want to get paid for my time. If they're not paying something, and I don't care if it's $500, you can charge them $200. If they pay you and they give you money, they're going to want something for the money. You're going to keep them engaged. And but when you can solve, that connects the dots. You're just not selling a product. And that's what when we were talking about the plan today on the guy with the 1.8 in crypto. Easy to say, well, that's not what I want to do, but here's what I would pay, you can pay me for a financial plan. Great, I'm glad you've made that money and glad your wife has been a good steward of savings. Y'all need $300,000 in income. I don't know that you're going to get there retiring at 56, much less with the volatility that goes with crypto.
You can retire at 56 as long as you die by your 60.
Yeah, and so.
There's always one sure way to make sure you don't run out of money.
Yeah, right. I wanted to ask a couple questions. One, I think you showed me there at the end, but you've got a process of documenting when you make changes, the rationale, why you removed one fund or put in another, correct? And then ETFs versus mutual funds. Have you evolved in using more ETFs versus mutual funds, if that option exists,
So,
for tax efficiency?
yes, we use ETFs, particularly like Russell 1000 Growth, S&P, if we're using Dow, mid-cap, we'll use ETFs where possible. And then we still use the mutual funds. My favorite high-yield bond fund is Osterweis. They just do a great job and low duration, and so, but.
And then model changes. If the model changes, the model changes. Doesn't matter if it's qualified, non-qualified. You trade out of those positions regardless of capital gains.
So we have not broken our book out between qualified, non-qualified.
Treat them all the same.
The dividend income portfolio is tax efficient. The large cap growth portfolio is not. We're going to have capital gains. If a client, needs to raise money or something's going on, they will tell Ben, my budget for capital gains on this taxable account is $5,000. We trade, when we trade to, if it's a taxable account, to either, if we got gains we can take, we'll take them, or we ask for that budget from the advisor, and then Ben does his best to work around it.
So really, all your clients are in the same models. You don't have a situation, especially when you start buying individual stocks, like you added some Cisco to somebody's account 10 years ago. If that's still in your model, if someone's getting Cisco at today's price.
Yes. If now if we have something that we're thinking about selling or we're not comfortable with, whether it's a mutual fund, ETF, or a stock, Ben will go in and put a hold on it. So, and whatever the replacement's going to be. So we will work out of positions. Somebody has 400 shares of Harley Davidson and they just don't want to sell it, and they're not opening a brokerage account.
Pretend like it's not there.
We just turn it off not to trade. And then, I mean, we've got various portfolios on those where, back to your tax question, where we've got the municipal bonds in lieu of corporate bonds. Instead of high yield bonds, we've got high yield muni bonds. So we can and do customize them. Amy came from another firm, and we still have probably 10 accounts that are run in a separate model. But at this point, 80% is what we're doing. So it's easy enough to customize.
One last question. When you come to visit us in Italy for a month, can you turn it off and can that process run without you?
Yes, 100%.
Is that invitation?
Invitation's already out there.
What's the overall cost of your portfolio before your management fee?
What's
The
the,
overall cost of the portfolio, now that you're using a lot of ETFs and things like that.
I've got it. It runs about 43 basis points.
Okay.
It's more like 18 or 17 on the iShares portfolio. Actually lower, it's 11. The blue chip runs 52 basis points. You got some more smaller mid-cap managers that are more.
What's your range of advisory fees then?
We start at 1.25. At 10 million, it's probably 0.5%. Kind of stair steps down from there. But we, you know, and you have to, you know, for those that don't know or practice very well, Ben Butler has worked for me since he was 16. Ben's 28 now. And so Ben has helped me develop the processes. He does our trading. He helps me with the research.
Right.
So this is, I mean, besides my first dividend income portfolio in 1989, you know, of 20 dividend stocks, I mean, Ben's helped this evolve.
Right.
And you know, he probably spends 7-8 hours a week trading, and an hour and a half, maybe 2 hours on Fridays putting the reports together. But it's we've created something that I can review it from anywhere. It goes into 365. Anybody can, our team can find it. It can be emailed to me, you know, if I've got a question and I'm, you know, out of town.
So the decisions to buy and sell are really based on the research that you're purchasing, right? When they tell you a stock's overvalued, undervalued, or...
So I ultimately have the decision, and that's where it becomes art or science. You know, trying to think. Well, I mean, right now we've got Noble, the dividend achievers, large cap. I mean, it just hadn't performed that great. It helped us in 2022, but it was only up 6% this year. And so, I mean, we're taking some time to look, and because that dividend income 60/40 was up maybe 10.5%, 11%, where the index was up 14.
Right.
And so I've isolated. I know that Seafair Emerging Markets was accounted for 1% of it. Another 1% was from Noble. And the other 2% was the S&P 500 and not having a running ton of NVIDIA. So we'll go and back test. We use Y charts, sent some different, you know, changes to BlackRock, to Dev Shaw, and said, hey, can you back test and run this for me? I'm trying to optimize.
Do you have a process or schedule that you follow to evaluate drift, or how is it instinctual? How do you decide when to rebalance?
So that's a great question. So what have found in our practice is during the course of a year, money's coming in or money's going out. That's the natural time to change the allocation. We don't just specifically go in and just do a hard, you gotta rebalance back. When we meet with the clients, we run that Wealth Vision allocation report. And so on each different account, we say, okay, you're underweight stock and we're going to rebalance back. So it comes cash in, cash out, and the annual review. With our IRAs, I mean, we paid out $6-7 million in RMDs this year. So that's a natural time. The way the trading portfolio works, if you go to sell, you can sell a specific swap.
Right, did you trade the target or?
We trade to target, and we've got some pretty high limits, so we don't get a bunch of nickel and dime. And so we try to trade them individually. And before it was released, Ben knows there are going to be 3 trades, not 18. I mean, let's face it, CPAs and clients don't want to see 18 trades. I mean, they don't want to see in a taxable account what goes on from Morgan Stanley in an SMA account with 300 positions. So we really try to be cognizant of that. My largest account is $20 million. He had $37,000 in capital gains last year. He had much more in dividends. He's like, "What? You didn't trade much?" I said, "Paul, you told me you don't want to pay taxes. You don't want capital gains, and we're being tax efficient and keeping the portfolio in line." So back to that, when you have that process, I can walk into any meeting with this and not have looked at it, but I know what's there. I don't know what the number's going to be from month to month, but.
So since Ben's doing your trading, has he implemented or tested any with the new rebalancer that ClientWorks has come out with?
Absolutely not. And we have not done anything with it because we trade in sleeves. So our large cap, if they're 3, the small and mid, and they, as of 2 weeks before Christmas, had not, I think, worked the kinks out of it. But no, Ben has avoided me in that conversation of having to move to the new trading platform. Hopefully it'll be smoother, but
Well, they got some kinks to work out.
So, we're not really looking to change everything, but we aren't going to have a choice ultimately.
What is the time of
Hmm?
that? What are they, so I think they're trying to get through, like they were going to do something like June or something like that, but people who have it, and if the new one's not doing what the old one's doing it, they're giving exceptions to let people keep the, so I think the training department is still.
And it,
I wasn't asking for us to make the trades, but just setting it up to where he could get alerts whenever things are out of drift. Like far as the, like 5% variance and things of that nature, just pull it up, say, hey, here's the 17 accounts you need to look at.
Yeah.
He was using it for that point.
And so the way I run my practice, if I've got 75 households I'm trying to service, and Ben's got the ones I tell you, I don't want to meet with anybody in December if I don't have to, and I don't want to meet anybody in July. I divide 10 by 75, so I have 8 appointments a month, and that's when I rebalance, that's when I do it. And, and this is a debate, and I'd love y'all's feedback. You get a time when the market's down 20%, who actually goes in and rebalances their allocation and increases their equity when the market's down like that? I mean, does anybody?
Every time I've done that.
Really?
No.
I mean, I can tell you,
It's hard.
It's hard.
to do because you never know, like yeah, you don't know.
And we're constantly evaluating cash as it builds up, so we're always putting a little bit of cash to work, and that's the opportunity to rebalance. New cash obviously coming in is a way to rebalance. And then that at least that one annual review, we're looking at the drift, and we'll make a change then.
and so
Like,
when,
that person could be a February review, or that person could be a November review. So again, it's based on where they are in that time frame.
and so for cash comes in and it's to be deployed, there are 2 choices unless you tell Ben something else. we're going to purchase immediately. Client understands it can go up or go down. Client's concerned, we're going to dollar cost average over 3 months. That is our standard procedure. Somebody, Ben's not there and someone says, well, Mr. Smith's got $15,000. He wants to know why. Well, I look and see that, we've done $15,000 trades twice and there's 15 less. Oh, yes, Mr. Smith. Yeah, our policy, if we don't just go straight in, that we'll do a third, a third, and a third. Oh, you know what? Ben told me. And but if somebody, has to do it over 6 months, I mean, Ben's pretty detailed, so it works. Any other questions?
It's great. Yeah, thank you for putting it together.
It's interesting when you have something that you do every day, but when you try to harness it into, something that, one, you just don't want to sit and read, but two, you want to be able to demonstrate if somebody asks, what we're doing. So it was,
Glad you don't have the flu this year.
yes,
Glad you don't have the flu.
you and me both. God, it's like, this is one of those, I think back to it, it's just like, it's one of those 3 or 4 days where it's a tunnel. Are we done, Hayes?
Yeah, 3 or 4 weeks left.
Okay. Well, thank y'all.
Thank you.